All right, welcome to another episode of Uncommon Entrepreneurs Lunch and Learn. I'm your host, Drew, here today with Jack Krupey. Welcome back. We filmed our first back a few months ago in June and got a lot of positive feedback. It was one of the most watched and viewed and commented on videos. So we wanted to kind of make a part two, which is kind of dive deeper in kind of like the real estate and your background and everything like that. So if you want to get more into his kind of story and how he came to Puerto Rico and everything, for sure, check out that video and it'll go in depth as far as that goes. Today's episode is sponsored by Donate PR, which is a donation platform for Puerto Rican nonprofits, 1101 qualified. It's check it out. It's a very efficient website, and you can use it for that. We're also in beautiful Coco House, which is a co-working space here in Santurce. You want to check out as well. So, kind of getting in a little bit of Jack's background, I'll let you kind of go into it. But you've had you're a seasoned real estate and distressed debt investor, spent 10 years focusing on residential non-performing mortgage market, and where you were working with the firm PRP Advisors, where you guys had completed over $3 billion in whole loan purchases to date. And you moved to Puerto Rico a couple of years ago. That's where we had connected and everything like that. You just wrapped up an MBA at Kellogg, right? Working in Hong Kong, so you have some Asian presence as far as that goes. And now you're launching JK Asset Management, which is an Act 20 company which invests and consults in alternative asset space, including distressed loans and real estate, as well as other real estate syndications, which we'll be getting into, obviously, in this conversation. So welcome back. Appreciate you.
Thanks for having me back.
Yeah,
am I the first multi-time guest at this point?
You are, yeah.
Ah, I'm honored.
Yeah, you should be. Yeah. So, kind of getting into things, maybe fill us in a little bit more on your story, maybe not as in-depth as the last one, but just give people kind of perspective on your credibility and where you come from.
Sure. So I actually started in real estate in 2001, just after graduating college. Had an information technology degree, but was fortunate to graduate during the dot-com crisis. So I've been through multiple cycles at this point. But it was probably the best thing that ever happened to me. I got into real estate, spent the first 5 or 6 years just doing all the traditional real estate, flipping houses, owned a bunch of rental properties. After the 2008 crisis, I ended up at a private equity fund in New York where we started buying non-performing mortgages. So from 2008 through really the present time, but through 2019, I was in New York, first on Wall Street, then in Midtown in a private equity fund. And we had over 30,000 loans on our books, bought from Fannie Mae, Goldman, Morgan Stanley, all the major broker dealers, and dealt with distressed loans in every state. We for a while, we didn't have a North Dakota property. Then after the oil prices dropped, we actually even had a North Dakota foreclosure. So it was a really great run. But after a while, New York... New York can burn you out after some time, and I'm really an entrepreneurial guy. So I knew a couple friends that moved to Puerto Rico, and it's amazing here. Obviously, the tax benefits got my attention, but now that I'm here, I love the weather. I love the community. The biggest part is the community. Just going out to an event like the events you throw, and everything from a small poker game to a big Uncommon Entrepreneurs event has been just thoroughly enjoyable. The caliber of people and the network here is incredible.
Which has kind of led to us doing investor dinners, kind of private, more focused ones, if you want to maybe hit on that.
Yeah, absolutely. There was we did that first event we did, which sort of came together, somewhat impromptu. It was really amazing. And when you do the big events, and especially with COVID, it's a little harder to do the bigger events, but I'm really a business nerd, a deal nerd. I really like to kind of do a deeper dive and really, make it like a mastermind and, learn about other people's businesses and talk about things I'm doing to people that, may be interested in learning more about the types of deals I'm working on. So, it's great. I really enjoyed the one we put together, and looking forward to doing these more often.
Yeah, exactly. So, for sure. So kind of getting into it, we're going to be, talking back and forth on his previous episode. This was June, a few months after, the COVID process had started. And so now we're in September, and, we're going to maybe like a market update from you, as well as we'll kind of go through some slides that I think will give some context on kind of what you're developing with your fund. And so, so we're in September. How do you see the real estate market kind of developing?
Yeah, so the real estate market, I believe I said on the last episode that I really wasn't too concerned with the residential real estate market, and that's still very much the case. So, I mean, there's a little bit of concern that we're monitoring what happens when the government stimulus slows down. I don't see that happening before the election. I don't think either side has any wherewithal to say no to more stimulus. They'll go back and forth about how to divvy it up, but ultimately they're gonna. I think they'll get something done. But it really still comes down to supply. The thesis I had back then was that there's not going to be enough supply of residential housing. The building never fully caught up after the last crisis, so there was already a shortage of newer construction. And right now, who wants to list their house for sale and have strangers walking through with COVID? And very, very few people are actually listing it. I'm sorry, very few people are really listing their houses unless they absolutely have to. So there's definitely a housing shortage. Commercial, the retail, office, I think it's a calm before the storm. It's just going to take some time to work its way through. I saw you're starting to see a wave of defaults on hotels in New York. And these things will take time, but there's going to be a huge opportunity for first distressed debt to buy the loans at discounts. And then ultimately for repositioning opportunities. I was having a great conversation with an investor I know from Southern California who is tracking every restaurant and every sort of just whether it's a strip mall or just office building in these prime areas that he thinks would be perfect for residential. And I think over time you're going to see a lot of these buildings that are very well located in great areas that have been offices or restaurants for 30, 40 years that are just going to turn into mixed use, mostly residential, perhaps with just a smaller retail footprint, or even mixed use where there's a few floors of office and the rest of it is apartments. So you see these planned communities in many areas. They were already more popular with I think the millennial generation that doesn't really want to live fully in the suburbs but wants more space and wants some conveniences nearby for things they can't buy on Amazon. So I think that's the direction.
Yeah, makes sense, kind of the momentum in that way.
Yeah, and the other interesting thing recently is that the industrial, which was never an asset class I played heavily in, but given what's going on with Amazon and the move to online, you're going to see some repositioning of maybe a vacant Sears turns into a new Amazon warehouse or some other type of drop shipping presence. So things will adapt. The market will eventually correct, and there's going to be a lot of opportunities and a lot of pain for some, but a lot of opportunities for others.
So let's kind of get into market cycles. You've been through since 2001 through a couple of these. What is that? Where are we at? And give us some context.
Sure. So there's a great book by Howard Marks, the founder of Oaktree, and he repeats in the book constantly that history may not repeat itself, but it does rhyme. And I think that's the perfect analogy for this cycle. Leading into 2008, it was really the housing bust was really the trigger for it. But at the same time, the market really peaked in 2007. But there was a fair amount of stock market euphoria. The residential housing cycle was just something you'd never seen before with stated income loans, liar loans that they were called in the industry. There was sort of that if you could fog a mirror, you could get a mortgage. It was completely reckless, and it just got through the whole cycle. I mean, there's been movies, the book, The Big Short, it tells it better than I can tell it right now. This one is different. Obviously the market's been up, and it's recovered from even the drops in March, but really relatively cheap money from the Fed, which is now again really cheap money, and they're pumping in trillions of dollars. So the government's doing everything they can to prop up the market, and that's really hurting yields. It's really hard to find a good return on any of the publicly available vehicles. And I think it's going to be that way for when you have interest rates at practically zero, and there's nowhere for institutions to put their money safely except for the market. And when I'd call in the real estate sector, it's the publicly available real estate investment trusts and Class A assets that are institutional grade.
Got it.
So one of the things that I've been focusing on is where to get real yields.
Got it.
Where can you still make a double-digit return, and how do you do it tax efficiently? Because real estate investment trusts, let me back up. So dividend stocks, at least the dividend, unless it gets changed after the election, is still a qualified dividend, which means it gets taxed at the lower preferential rate. Real estate investment trusts, however, because they actually pass through without taking taxes at the entity level, those dividends are actually taxed higher. So the actual real rate of return on a REIT that pays a 7% dividend is not 7%, and that rate may vary based on people's income. And some of the new tax laws with that sort of the 20% charge comes off. It's too complicated to go into specifically, other than it's the similar reason people try to buy municipal bonds that are tax free, because their yields are lower, but it actually passes through a true yield. And I try to take that to a different level on my investments, which are actually buying into a partnership or an LLC where you get depreciation. It's one of the best benefits of both buying a rental property if you do it directly, or buying into a syndication, is that you actually get part of the depreciation. So you're getting your cash flow and generally not paying any tax on it until the property sells. And when the property sells, there's a capital gain. The downside of these types of assets and these types of structures is it's not a publicly traded vehicle. So these are not things you're going to put your money into and sell the next day. If you're in for a couple of years, and so you don't get the same liquidity, but you're getting multiple points of a better return in general. And the reason that real estate investment trusts go public is because they want to lower their cost of capital. So you pay for with liquidity, you pay for your lower cost of capital. And for me, again, I'm not going to put you keep a certain amount of savings, but if you have money on the sidelines, there's very rarely do you really need all of it right away. So I think it's better to lock up assets into longer term yields, and you're going to generate higher returns.
Got it. So maybe let's go through some of the asset classes that you invest in and you think are good investments.
Sure. So I've talked a bit about multifamily. And I have more on that, but I want to talk through a few of the other ones just to quickly highlight. Senior housing is an asset class that we're paying very close attention to. We actually may have an upcoming project. We're looking at partnering with a few senior housing developers that are building new construction, again, post-COVID, with all the proper HVAC systems with the negative pressure. And generally, they're going into markets that have only one or two other facilities, and there's generally waiting lists for those facilities. And they actually go through the whole cycle of life where it's active, where people still the seniors live on their own. And then there's a memory care division where they have more help as needed. And then there's the full nursing facilities. So a lot of the facilities that were built in the 70s or 80s, they kind of look like hospitals. These really do look like just a nice 50. It almost looks like a normal active adult community, but there's different wings that have more services as needed. And some of the returns on these deals are in the 20 to 30% range. So we're taking a very close look, and the demographics support the asset class for sure. Self-storage has been a mainstay recession-resistant asset class. In 2008, the self-storage actually went up as people downsized out of their houses. So to go back to the history, it may not repeat itself. In this market, I'm a little more concerned about self-storage because you have so many big box retailers going out of business. There's a lot of office space or other types of space. Exactly. So I'm a little more concerned that the barrier for entry for turning something into a self-storage may not be that high. And generally, if you have a facility and it's already up and running, people aren't going to go move their stuff from one facility to another for $20 a month, but it can over time depress prices and really stop the ability to expand. If you had a facility, you might have been able to build a new garage next to it. That's probably not going to happen if there's another facility open down the street. So we're being more careful with storage currently. And office and retail, we would buy loans against those. We certainly wouldn't acquire those and at anywhere close to retail prices. But what tends to happen in the mortgage market is the specialty servicers or the funds or banks that own those assets are penalized by the banking divisions for holding those assets. So they'll often sell those at significant discounts to the current as-is value.
Okay.
So even if it's a mall that has maybe only half the tenants are paying, and we don't know what the ultimate vacancy rate will be, if we're buying it at 30 or 40 cents on the dollar of current value, there's a price where it may make sense, or where you're close to the land value, and it may actually be worth more if it was just knocked down and ready to build something else. So. Those are the really distressed opportunities, which sometimes cross our desk where we may participate, but otherwise, not looking to get super active in the retail right now.
Got it. How about multifamily?
Yeah, so multifamily is the core asset class, and it's one that I've said I'm bullish on, and we've put our money where our mouth is. I think it's the perfect blend of current cash flow, potential upside, and with the interest rates where they are, you can also take advantage of federally backed financing with Fannie Mae and Freddie Mac. In some cases, as low. This recent deal, we're at 2.88%, and it's actually a very good hedge against inflation as well. I know there's a lot of people down here in this community that are gold bugs and Bitcoin and are very concerned about the U.S. dollar, and it's one of the more mainstream ways to hedge against inflation is just to lock in longer term fixed rate financing on an asset. And so multifamily, there's a couple different classes. I mentioned Class A before, where it's generally newer construction, higher end. It's generally the most expensive rental properties in an area. And often there's REITs and insurance companies and larger publicly traded companies that buy these large complexes. These are groups that are going to only spend a couple $100 million minimum to get into something, and they just want to buy the biggest and the best. And then there's Class C, which is generally lower income. Maybe there's a lot of Section 8 in there, and could be really require more hands-on management. We tend to shy away from those just because at this stage of my life and career, I don't need. We just don't want properties that can become headaches. And the class that we think is just right is the Class B. Some people will call it workforce housing, middle class housing. Generally, the types of properties we go after were built in the 70s, early 80s, and generally relatively full, 95% occupied, but just have room for value add. That could mean spending $3,000 to $7,000 per unit when they go vacant to update the flooring, update the cabinets. Often not even the entire cabinets, just the faces, and you could refinish them. New countertops, new bathroom fixtures, new tub, it's really a few $1,000s to really spruce it up. Often the amenities like the pool or the common areas need a little updating as well. And these are ideal type scenarios where you have cash flow, positive cash flow and profits the entire time, but over the course of 2 or 3 years, you can increase the rents significantly. And when you have a building that is generally bought at around a 5 to a 6% cap rate, if you raise the rents by $1,000 a year, that raises the value of the building by, you could divide it by 6, and it raises the value. $100 rent increase can raise the value of the building by thousands, and you times that by 100 units, you can force appreciation of your building to $1 million, $2 million just by updating it over the course of a few years.
Got it.
So there's actually a few live examples of deals we're working on right now. We're a partner in a deal in Augusta, Georgia. It has 104 units. And the economics of the deal that we're getting into for our fund is it's going to be roughly a 9% cash on cash return. So the first few years, we're still going to make 9% on our money as we renovate and update units. And we do expect over the course of what'll probably be a 5-year hold, the IRR is going to be between 15 and 20%, total internal rate of return or annual return, which doesn't match up exactly, but usually ends up close. And we expect to at least double our money over that period. We might even make 2 to 2.5%, 2 to 2.5 times our initial investment in the deal. There's another deal in Phoenix, Arizona, 288 units. The cash on cash return is a little lower because there's actually higher renovation, but the upside is potentially even more. And Phoenix is a market we really like. There's a lot of California refugees in Puerto Rico. Some won't go as far as Puerto Rico, but they stop in Phoenix. So it's always been a market where people have, it's Vegas and Phoenix are the two markets people from California tend to go to if they don't mind the heat. And demographically, especially with COVID, I think it's a great position to be in as a market. And again, these deals are actually limited. They're generally LLCs. So when I mention our fund, just to be clear, I guess I'll give a little shameless plug here. So we have a private placement. It's called Regulation D 506C. And so we've registered, and we are only allowed to work with accredited investors. So these are investors that meet certain education and net worth requirements. It's generally, they're just updating it now, but generally you need to have made $200,000 a year and or have $1 million net worth, one or the other, to be qualified. And that's a lot of the island, and really just a lot of just investors in general. Even if you have a 401k, that counts. And so we're certainly never looking to take grandma's money or the last $5,000. This is, but it's the type of thing that I found a lot of mid to high net worth people just weren't fully aware of, or they just don't know where to go.
Yeah.
These are the types of deals that you might have one guy from a country club or something that has a specific expertise in one market. What I found is there was a real need in the market to really aggregate these opportunities together and provide a little bit of diversity and across regions and across operators. Mm-hmm. So there was recently the hurricanes that went through Louisiana. If you had all your eggs in one basket in the building in Louisiana, or Houston a few years ago, there was obviously the big hurricane there. So we want diversity. So we have Georgia, Phoenix. There's another one in Jacksonville coming up. There could be another one in Richmond, Virginia. So we're really looking to create a diverse pool of 10 to 15 investments. So it's really a private real estate investment trust in a way. Mm-hmm. Then it's just launching. The last 10 or 15 years, I've always been in private equity where I had one big $1 billion backer, and it's exciting for me to be able to actually share this with my friends, family, and local community, because for 10 years I've had to turn down money. I've had so many people saying, "Hey, can I invest in your deals?" And it's like, sorry, it's only Wall Street guys and pension funds, and I don't have any control over it.
Yeah, what's maybe been the motivation for the transition?
So I've always been a deal junkie. I was the guy when I was 21, 22 telling people to buy a 2-family house and rent the other half out. So like I talked about the investment club, I've always been very, very much into opportunities and arbitrages, and I'm also coincidentally into points and miles. So I love figuring out how to fly somewhere for cheap on miles and sharing tips and strategies. So I think it really is a better fit for my personality. You spend a lot of time, figuring out what am I good at and what do I want to do and how do I want to spend my time.
Yep.
And I thoroughly enjoy just talking about possible opportunities, both with and educating investors, and on the deal flow side, just networking with other entrepreneurs. I'm at a stage where I'm not the guy who's going to be swinging a hammer at a property in Augusta, Georgia, but helping a good group of entrepreneurs that have a great property management company that are super detailed and diligent and want to spend their time actually fixing and improving the building and not talking to investors. It's a perfect marriage on these deals. One other key point on these deals, because I've heard some people have said, well, really, is it a fund of funds? And it's really not a fund of funds. It's a fund of joint ventures, if you will. But one of the needs in this market for those operators I mentioned is they generally need to raise a few $1 million for these projects within 30 to 60 days. And these deals are too small for Wall Street, but they're also potentially too big for the average investors. So a lot of these deals, these groups are going to their friends, their family. They're trying to put together as much money as they can in a short period of time. And a fund like ours is able to aggregate that money, and we actually get compensated with better deal terms. So if some of these deals, if an investor happened to know the same guy and wanted to put in $50,000, he'd get one deal. If we're putting in $500,000 or $1 million, which in some cases is 20% to 50% of the deal, we're getting better deal terms. So although my fund does charge a management fee, much or in some cases all of it ends up being covered because we actually get compensated in the deal, and those some of those fees actually flow through to the fund as additional return.
Got it. Interesting. I think that you've provided a lot of context, and this is very interesting investment class to be in, and with your experience, you've obviously been preparing your life for this, right? And especially with Kellogg and what you just graduated with. Any other parting thoughts or ideas that kind of coincide with what you're building?
I think I'm talking mostly about the mainland at this point. I've have 20 plus years of mainland experience. We're still looking heavily at Puerto Rico. I know a lot of the investors here also want to help improve the island.
Yep.
So, I do think over time we're going to have some projects that probably won't be part of the fund, but maybe separate individual opportunities that could make sense. And along that line, I want to hear from others on the island too. If there are interesting opportunities, we're certainly open to reviewing them and vetting them. I may be a little slower, more conservative on the island, just because, especially if we're going to put our name on something and potentially partner and use other people's money, we want to be more just 100% sure it's going to work. Because on the mainland, there's never 100% certainty. But on the mainland, these are pretty cookie cutter deals for me. As long as there's not a meteorite strike or just a major catastrophe that's worse than 2008, I feel reasonably confident to tell people that I think their principal is safe, and I have my own money in these deals as well. But on the island, it's still a learning curve. But I think there's a lot of value that our groups can add here, and certainly want to network with as many people as possible, both on Puerto Rico opportunities and mainland opportunities. And
yeah, I think that's a good point to be kind of leaving the audience with, is that let's facilitate conversations to with the deal flow, and the people are looking to maximize their tax benefits and opportunities, and exactly we're creatively we're stronger together.
Yeah, absolutely. I look at this as like a wealth management approach. As I said, I'm kind of a deal nerd anyway, and when I talk to people, I want to know what their situation is. Do they have do they still have U.S. sourced income? And does the passive depreciation actually help offset other passive income they may have in the state? So I really look at it. I'm not a formal financial advisor or CPA, but by being a business nerd and tax nerd, if you will, like many of us are here.
Yeah.
I certainly look at it as a collaborative approach, and I love these dinners we're setting up, and hopefully we can get any members of the community that are interested to come and network. And I generally will pick up part of the drinks for a while. You got to make sure it doesn't go too out of control, but it's fun for me to meet as many people as possible, because I've been on the island about 2 years, but I still had a lot of travel back and forth to Asia last year. So now that I'm here full time, I want to meet everybody and get some deals going.
Yeah. How do people get a hold of you?
So the website is JKAM Investments. It's JK Asset Management, so JKAM Investments. And we have a Facebook page. I'm on most social media. I'm on the various Facebook and WhatsApp groups. We'll put my cell phone in the show notes, I'm sure. And very easy to get a hold of, and happy to have a conversation. I'm never going to hard sell someone. I mean, it's just really I want to get to know people and just find if there's ways to collaborate.
Yeah, I like the approach. Definitely very educational. Appreciate you kind of explaining, giving context where the market's at the moment. I think there's a lot of good takeaways from this. Any other thoughts that come to mind? Or
yeah, I know. Talk to a number of people that are just really worried that the bottom may fall out of the economy, and I can't say that I'm generally bullish, especially on residential, but I keep thinking back to sort of the dollar cost averaging that everyone preaches for. This is the more traditional investing, and that's sort of the way I look at both the stock market and real estate. or whatever industries you're in, is if you're better to make small bets and slowly put some capital to work in areas. And even if real estate does correct a few percent over the course of 3 to 5 years, making good investment decisions in good buildings that we're happy to hold. I feel good about what we're going to do, and that's what I tell everybody for whatever asset class, including I'm a noob for crypto and Bitcoin, but I'm even throwing I'm practicing what I preach, because I'm throwing a little bit into Coinbase here and there, getting some investments going in crypto as well.
Yeah, diversification's key. Well, good. Appreciate you joining, Jack. It's always a pleasure, and for sure, I agree with what you're saying. You're very open and free to get to know, and very knowledgeable, and just free to share information, which is always what I've appreciated. So definitely reach out, and great. Appreciate you coming on.
Absolutely.
Yeah,
Thanks for having me.
Yeah.